Globally, people are experiencing inflation as the cost of food, gasoline, energy, and several other everyday necessities continue to climb quickly. This is a big change because most wealthy economies, which are frequently removed from the problem due to their relatively low inflation rates, are now experiencing the full severity of the situation as well. Consumers in the United States are paying 8.5% more for everyday goods now than they did a year ago, which is easily the largest rate hike in more than 40 years. In the United Kingdom, the year-on-year price increase is 6.2%, the highest pace in decades. Africa is not immune to this experience, with countries on the continent printing record high inflation rates in 2022. Inflation is defined as the progressive increase in the price of goods and services, followed by a fall in the value of a currency. Governments typically determine official consumer inflation numbers that are released on a national level. They monitor a basket of frequently purchased items to determine price changes. These will, for instance, include the cost of food and drink, clothing, footwear, transportation, and energy. There are various potential reasons for inflation, but the two basic categorizations used by economists include cost push and demand pull. When the costs of producing goods and services rise, consumers face higher prices for end products, which is referred to as cost push. However, demand pull, on the other hand, is the phenomenon where prices increase when there is a gap between supply and demand. Today's inflation is mostly driven by cost push. Energy is a component in the majority of goods and services, and when its price increases, companies will be forced to pass on the cost. Supply interruption induced by the COVID-19 pandemic had a similar effect in China and elsewhere. Components, consumer electronics, and vehicle parts were in short supply, and ultimately forced prices to soar. Although it's impossible to avoid inflation entirely, there may be some things you can do to mitigate its impact on your finances. To begin, it is critical to distinguish between short-term inflation and long-term inflation. Short-term inflation is frequently caused by supply and demand difficulties, which drive competition and temporarily raise prices. Long-term inflation is more gradual and reliant on a broader range of factors. The ability to prepare financially for the economic ups and downs depends on an in-depth understanding of how inflation works and the steps taken to limit its negative effects on quality of life. So our video today describes concise steps that could be taken to survive inflation. Be sure to like, comment, and subscribe to our channel for more exciting future videos. It is essential to consider how inflation may affect the costs when planning any major purchases or projects, such as house renovations or the purchase of a new car, and if any price rises are likely to be temporary or long-term. For instance, timber prices increased as a result of the pandemic's effects on the supply chain and other factors, but they are already starting to decline from recent all-time highs. Realizing that these price hikes would only last a short while could help in making informed decisions to avoid or delay certain woodworks that aren't pressing, for instance, until the market stabilizes. And if there are indications of inventory shortages in the avenues for investments and spending, there is the option to either engage right away or start saving up additional money to cover any price increases. Because both temporary and long-term inflation will affect the cost of ordinary things, it's critical that budgets are examined on a frequent basis to ensure accounting for price changes over time. When it is apparent that inflation may be pushing prices up, it is imperative to take into account strategies to conserve money in areas like gas, utilities, and food if a sizable portion of a budget is allocated to purchases like these that can be affected by temporary price spikes. Aside from investing for the future, one of the best methods to preserve your finances is to keep emergency funds on hand at all times. An emergency fund is a specialized savings account in which you save extra money for unanticipated expenses. While an emergency fund will not directly shield you from inflation, it will help you plan for unexpected costs if transitory price variations cause you to go over budget. For example, if fuel prices rise owing to market conditions, it may disrupt your monthly budget. Having an emergency fund in place may provide you with the breathing room you require until you can revise your budget. Even though having an emergency fund won't directly shield you from inflation, it can help you plan for extra expenses if brief price swings cause you to go over your budget. For instance, if fuel prices rise as a result of market circumstances, it can ruin your monthly spending plan. If you have an emergency fund set up, you might gain the breathing room you require until you have the opportunity to adjust your budget. Though requesting a raise is an excellent strategy to safeguard your personal finances, keep in mind that many firms adjust compensation over time to account for increases in the cost of living. Asking for a raise could help stay up with the cost of living as inflation rises, particularly as the value of a dollar declines. It could be tough to maintain usual expenditure if the price of things rises over time but wages stay the same. Even while inflation may drive up the price of necessities, when income rises, it allows people to meet the additive new costs because they earn more money each month. Having assets and investments that increase in value is a terrific method for the average consumer to fend off the effects of inflation. Positioning your money to grow over time means that if your investments perform well, your dollar will ideally outperform inflation, which frequently causes the worth of money to fall. It is essential that investments in retirement accounts, such as retirement savings account offered by employers as part of their employee benefits programs, individual retirement account, or other retirement accounts, are diversified among equities, bonds, index funds, and other investment vehicles with various risk profiles. Speaking with an investment advisor or a retirement account representative is a vital step that can ensure a suitable mix of investments that ideally will outperform inflation while also reducing risk. Finding the best investments to use as an inflation hedge will involve some investigation, aside from your investment portfolio and retirement accounts. But hey, you are in luck, as this video will dive into some reliable investment inflation hedges. A stock, often known as equity, is a type of investment that represents a fractional piece of a company's ownership. When you buy stock from a corporation, you become a shareholder, and the small amount of stock you possess is known as a share. Investors purchase and hold stocks in the belief that the firm will prosper. When the company works well, its stockholders benefit from the profits. Generally, stock returns often outperform inflation. Increased profits for businesses can lead to higher prices, which in turn raises share values. There are no certainties, of course, but traditionally the stock market has delivered returns that have outpaced inflation over the long run. By opening an account with a stockbroker, investors can purchase and sell public stocks. There are currently several brokers who do not charge commissions on stock trades and allow customers to purchase fractional shares of stock. Real estate investing has a lot of benefits. This asset category offers stable income through dividends and has inherent value. Due to the constant need for housing, regardless of the state of the economy, and the fact that as inflation increases, so do property values and rental rates, it frequently serves as an excellent inflation hedge. However, real estate is illiquid because it is a tangible asset. A tangible asset is one that often has a physical form and a finite monetary worth. Real estate investment trusts, which are more liquid investments that can be bought and sold easily in the markets, are an alternative to take into account. Companies that hold and manage portfolios of industrial, residential, and commercial buildings are known as real estate investment trusts. They frequently offer better returns than bonds and generate income through leases and rents. Another major benefit is that because of their relatively stable operational costs, their prices are likely to be less impacted when interest rates start to climb. When interest rates are extremely low or inflation picks up, investors have historically turned to gold as a safe haven asset. When real interest rates, defined as the reported rate of interest minus the rate of inflation, fall into the negative range, gold typically performs well. Investors frequently consider gold as a store of value during lean economic times, and it has traditionally served this function well. Investing in gold through an exchange-traded fund is a wise choice because you won't have to store or guard the metal on your own. Furthermore, exchange-traded funds provide a range of options for owning actual gold or the equities of gold miners, which can have a greater upside if gold prices climb. Prices for basic materials such as oil, metals, and agricultural items typically rise in tandem with inflation, making them a suitable hedge against it. However, investors should be aware that commodities can be exceedingly dangerous. Commodity prices are heavily influenced by supply and demand, which can be highly volatile. This makes them a dangerous investment, especially if investors are using leverage. The possibility of rewards is high, but so is the potential of losses. So there you have it, the steps that could be taken to survive inflation. If you enjoyed this video, watch also the next video on your screen, which looks at the 30 business ideas that will make you an instant millionaire in Africa. Don't forget to give our video a like, subscribe, and comment for more exciting and future videos.